Imagine a future where you are financially secure, not because of the hours you put into work, but because of the smart decisions you made early on. We're talking about the power of investing. It's about more than just making your money work for you. Investing is a strategic journey towards financial growth and independence. It's about taking control of your future and creating a safety net for unexpected life events. The beauty of investing is its potential to multiply your wealth over time, transforming a small seed into a thriving money tree. But remember, investing isn't a get-rich-quick scheme. It requires careful thought, planning, and patience. The key is to start now. Every day that passes is a missed opportunity for your money to grow. So why wait? Let's embark on this journey together and discover the world of investing. The road to wealth is paved with prudent investment decisions. Principle number 1, start early. Imagine a snowball rolling down a hill. As it descends, it gathers more snow, growing larger and faster. This is the magic of compound interest. The sooner you start investing, the more time your money has to grow, to roll down that hill and accumulate. It's about giving your investments the greatest possible amount of time to work for you. The early bird gets the worm, and in investing, the early bird gets the compound interest. Principle number 2, diversify. Picture a financial ecosystem, thriving with a variety of investments. This is diversification. By spreading your investments across different asset classes, like stocks, bonds, and real estate, you reduce the risk tied to any single investment. It's a safeguard, a buffer against the unpredictable. Diversification also opens up avenues for potential returns, giving you multiple shots at success. Remember, investing is not about putting all your hopes on one star. Don't put all your eggs in one basket. Diversify. Let's move on to principles 3 to 5. Risk management, consistency, and patience. Risk management is the cornerstone of successful investing. It's all about striking a balance between potential reward and the level of risk you're willing to accept. Ignoring this principle can lead to substantial losses. Next, let's talk about consistency. Consistent investing, irrespective of the market conditions, allows you to take advantage of dollar-cost averaging. It means you're buying more shares when prices are low and fewer when they're high. It's a time-tested way to grow your investment. Finally, we have patience. The most successful investors are those who understand that wealth creation is a marathon, not a sprint. It's about letting your investments grow over time, resisting the urge to make hasty decisions based on short-term market fluctuations. Manage your risk, be consistent, and be patient. Remember, Rome wasn't built in a day. Now let's explore principles 6 to 10. The 6th principle of investing is knowledge. Knowledge is the key to making informed decisions in the world of investing. This isn't about having a degree in finance, but about understanding the basics of the market, the nature of the investments you're making, and the potential risks and rewards involved. You don't need to be a Wall Street whiz, but a well-informed investor is a successful investor. Principle 7 warns us to avoid emotional investing. It's easy to let emotions guide our decisions, especially when it comes to money. But emotional reactions often lead to rash decisions that can harm your financial health. Whether you're reacting out of fear during a market downturn or out of greed during a boom, it's crucial to step back, take a deep breath, and make decisions based on rational analysis, not emotional reactions. The 8th principle is to stick to your plan. A well-defined investment plan is your roadmap to financial success. It helps you navigate market fluctuations and keeps you focused on your long-term goals. It's tempting to deviate from your plan when faced with short-term market swings. But remember, consistency is key. Principle 9 advises us not to follow the herd. Herd mentality can be a dangerous pitfall for investors. Just because everyone else is pouring money into a particular stock or pulling out of the market entirely doesn't mean it's the right move for you. Your investment decisions should be based on your own financial goals and risk tolerance, not on what everyone else is doing. And finally, the 10th principle reminds us to review our investments. Regular review is crucial to ensure your investments are performing as expected and to make any necessary adjustments. This doesn't mean obsessively checking your portfolio every day, but rather taking the time to thoroughly review your investments on a regular basis, such as quarterly or annually. Knowledge is power, emotions are not your friend. Stick to the plan, don't follow the crowd, and always review your investments. Ready for principles 11 to 15? Let's dive into principle 11. Understand your investments. This might seem like a given, but it's surprising how often people invest in assets they don't fully comprehend. Whether it's stocks, bonds, real estate, or cryptocurrencies, take the time to understand what you're putting your money into. The more you know about your investments, the better equipped you'll be to make sound decisions. Moving on to Principle 12. Don't try to time the market. It's tempting to think you can outsmart the market, buy low and sell high. But here's the truth. Even seasoned investors struggle with market timing. Instead, focus on long-term strategies like dollar-cost averaging, where you invest a fixed amount periodically regardless of market conditions. This approach mitigates the risk of making poor decisions based on short-term market fluctuations. Now, Principle 13. Keep costs low. Investing isn't free. There are fees, charges, and sometimes taxes. These costs might seem small, but over time, they can eat into your returns significantly. Look for low-cost investment options and platforms. And remember, it's not just about finding the investment with the highest return, but the one with the best net return after fees. Next up, Principle 14. Invest in what you believe in. Your investments should align with your values and beliefs. If you're passionate about technology, consider investing in tech companies. If you care about the environment, there are plenty of green companies to invest in. When you invest in what you believe in, you're more likely to stay the course during turbulent times. And finally, Principle 15. Don't be afraid to ask for help. Investing can be complex, and there's no shame in seeking advice. Consider consulting with a financial advisor or using robo-advisors. These tools can provide valuable insights and help you make informed decisions. Understand before you invest, timing isn't everything. Low cost is key. Invest in your beliefs and don't hesitate to ask for help. These principles will guide you towards becoming a successful investor. And finally, Principles 16 to 20. Let's start with Principle 16. Keep it simple. Investing can be complex, but it doesn't have to be. Look for straightforward investment options that you understand. Consider index funds, which offer a simple way to diversify and keep costs low. Remember, complexity often breeds confusion, and confusion can lead to mistakes. Moving on to Principle 17, we have an emergency fund. Life is unpredictable, and financial emergencies can strike at any time. Your emergency fund is your financial safety net. It should be enough to cover 3 to 6 months of living expenses. This fund isn't for investing, it's for peace of mind. Next, Principle 18. Invest regularly. This is where the concept of dollar-cost averaging comes into play. By investing a fixed amount on a regular schedule, you buy more shares when prices are low and fewer when prices are high. Over time, this can reduce the impact of market volatility on your investments. Principle 19 is all about rebalancing your portfolio. Over time, your asset allocation can drift away from your original target due to market fluctuations. Rebalancing your portfolio helps you maintain your desired risk level by selling assets that have increased in proportion and buying those that have decreased. This isn't something you need to do constantly, but it's a good habit to check at least once a year. Last but not least, Principle 20. Keep your expectations realistic. The stock market isn't a get-rich-quick scheme. It's a tool for building wealth over the long term. Don't expect to beat the market every year. Instead, aim for a reasonable, sustainable return. Remember, slow and steady wins the race. So there you have it, Principles 16 to 20 of investing. Keep it simple, have a safety net, invest regularly, rebalance as needed, and stay grounded in reality. These principles serve as a compass to guide you on your investing journey. Stick to them and you'll be well on your way to financial success. And there you have it, the 20 principles of investing. From the first principle of starting early to the last principle of keeping your expectations realistic, each one carries its own weight in the realm of investing. Diversification, risk management, consistency, and patience form the backbone of a solid investment strategy. Knowledge, emotional control, sticking to your plan, not following the herd, and regular reviews keep you on track. The next set of principles: understanding your investments, not trying to time the market, keeping costs low, investing in your beliefs and not fearing to ask for help, further fortify your financial journey. And lastly, simplicity, an emergency fund, regular investments, portfolio rebalancing, and realistic expectations ensure you stay grounded while aiming for the stars. Remember, investing is a journey, not a destination. Equip yourself with these principles and take the first step towards your financial future today.